Today, I'm going to show you my top 3 strategies to use on a $50,000 account to try to generate a consistent 15 to 20% return annually. So before we start with the actual strategy, I would like to tell you what edges are easy to capture as a retail option trader. The first one is positive drift. The market over the long run goes up. We can see here SPY, S&P 500, and we can see that over a long period of time, the market always keeps making higher highs. The second one is variance risk premium. Variance risk premium is well known in the Theta gang type of strategies. It's that implied volatility is usually higher than realized, and that's our edge. How can we look at that? Well, here is a graphic from the CBOE with implied, and you can see as the implied is usually always above the realized. It's not all the time. There's periods in which the realized can surpass the implied volatility, but taking advantage of this delta is the edge that you get that's usually called the variance risk premium. One important thing to notice is that when implied volatility gets too high, and this might be a little bit counterintuitive, when it gets too high, periods like here is the periods in which realized tends to surpass the implied. On the other hand of the spectrum, when it gets too low, like below VIX gets below 15, it's very difficult to have VRP because the delta in between the realized and the implied can only be so large. So you want to be selling implied volatility when it's above the expected realized, but at the same time you usually want to avoid the extremes when it's very high or when it's very low. My strategies are based on 3 types. First, volatility-based strategies, and here I'm mostly using strangles when IV is elevated. Again, IV should be elevated, not related to itself, related to the realized volatility. I'm usually selling strangles of about 0.2 delta, and I take here an example in IWM, the Russells. You can see how a profit profile looks like. If it is in between the strikes, in this case 247 to 275, you gain max profit at expiration. Anything above or below your target strikes will incur you in a loss. Usually, I'm not holding to expiration. I'm usually looking at this around tasty mechanics, meaning I'm selling strangles about 30 to 50 days out with a delta of about 0.16 to 0.2, and I'm looking to manage them at around 21 days. For example, in this IWM short strangle, the open credit that we get is $364. That's the max profit that we can achieve. The margin requirement is $1,700. That's what my broker is asking me to put up front to guarantee this trade. And one thing is that IVP is very low, around 4%. So this might not be the ideal situation to be selling volatility in a product like this, but across the board, with the VIX at around 14, it's very difficult to find good products to sell volatility as of today. One thing that I like about this trade and that we should look at when we are looking at volatility is not just the volatility compared with itself. Yes, IVP is low, but you can see that the realized volatility has been trending even lower. I like very much to use this chart in Interactive Broker platform, and you can see that in orange you have your 30 days realized volatility, and in yellow you have 10 days realized volatility. You can see that they have been trending lower, and actually this gap has been widening over the past week. So while the actual volatility number is rather low, this might be a good opportunity to sell volatility in IWM. My next type of strategy is what I call semi-directional. In here I divide in 2, but in reality short puts and the wheel are kind of the same thing. The only difference is that I select up front if I'm willing to take assignment if the position goes against me, or if I have a stop loss. Lately, I've been trending more towards having a stop loss, therefore the short put. I think it's a more efficient use of capital, mainly for smaller accounts. When you start doing the wheel and your product is like 10-20% of your account, and it goes against you, you don't have many tools. You just have to wait and sit on your hands for a long time. Short puts helps you to close the position and move on. Just accept the loss, move on, and trade another day. One position that I've entered in recently that I can share with you guys is, for example, UPS. I entered here in UPS in the first circle. You can see after the earnings announcement, there was a big gap up, and after that, the stock was drifting slowly higher. I entered in this position since IV was still relatively elevated compared with HV, and mostly that HV, you can see here on the 29th of December, HV was just trending down, both the 10 days and the 30 days volatility, giving me a good opportunity to capture in case this keeps trending down. So I sold a put, and that was a 30 delta 98 put on the 29th of December. So I sold a put that was a 30 delta 98 put on the 29th of December, and that was a $91 credit to open this position. The expiry was on 16th of Jan, so I had about a 20 days to expiry position going on. Usually when I'm selling short puts, I'm looking at about 20 to 30 days to expiration positions. You can see after just a few days, so in less than 10 days, the position rallied and I was able to close it for just $18, so I locked in a profit of $72 in. The stop loss that I defined at the time was $92, so it was just below this handle of stabilization after the gap up with earnings. I'm usually looking for positions that when the stock reverses, and if it would have gone below this handle, it meant that I was wrong. The stock was not drifting higher anymore, it was actually going lower. One mistake that people do is that they look for products with high volatility and they focus more on Theta compared with Delta. The thing in reality is this strategy is mainly determined by Delta. You want the product to not go down. If the product does not go down, you make money. Doesn't matter the volatility. Of course, the more volatility there is, the more you can capture and the more credit up front you are going to get. But do not make the mistake of thinking I'm going to sell high volatility products to capture more upfront, and then you are kept back holding a product that you don't want to have. To me, a mistake that many option traders do, that I see it on Reddit or on other platforms, is just focus on selling options, focus on selling volatility, and using these as a one-size-fits-all. However, when the VIX is low like now, and it is difficult to find variance risk premium trades, it will be really difficult to overperform the market. I think that we as retail traders have the opportunity to be flexible and adjust to what the market gives us. Therefore, I think that we must incorporate some directional strategies, and here I'm looking at different types of profit mechanisms. I'm looking usually at breakouts or post-earnings announcement drift or MACD crossovers. That's usually a momentum capturing strategy. I will talk this in more detail in some later video. You can find the link in the description. One example of a trade that I have with this strategy is a ratio call diagonal. It means I'm buying, for example, 90, 180 days out long calls, and then I'm selling shorter duration calls with a lower delta. Usually for the longs I'm using about 0.7, 0.8 delta, and for the shorts I'm usually looking at 0.3 delta with about 20 to 30 DTE. The idea here is that the long calls give me the profit potential for the upsides, and the short calls limit my bleeding out Theta and give me some Theta to capture over time, so I can capture some premium along the way while I have this trade. One trade that I have on right now is on EEM, so that's the Emerging Markets ETF, and you can see here that this broke out of about a 3 months range on earlier this week. This breakout was a trigger for me. I had an alarm set up and it was trigger for me for entry, and I entered with 3 long calls. My expectation is if the breakout continues, I'm not going to sell my shorts just yet. I'm going to wait until the product stabilizes after the breakout, and when it does, I'm going to sell my shorts to not bleed the Theta. That happened about 3 days later. As you can see, in the beginning it kept rallying, and then after 3 days it dropped and it has been stabilizing a little bit, but it's still above my breakout point. At that point, I decided to sell 258 calls on a shorter duration, 16 days out. So right now I have 3 long calls that I bought for about $1,000 and 2 short calls that cover my Theta per day, so that I'm not bleeding out Theta. I'm actually capturing some premium while this trade is working in my favor. If it crosses below the black line that I define as my stop loss at about 55, I'm going to close this position and assume the loss. If it keeps rallying, then I just keep rolling out my short calls and capturing more and more Theta, but also the delta of the position keeps being captured, and this is a bullish trade after all. The reality is that a $50,000 account is still a small account. You cannot even sell one single put on SPY. You need to be able to have a blend of different strategies to avoid having all your eggs in the same basket. For me, I use these 3 types of buckets of strategy and I allocate them different percentages. These percentages vary depending on the market conditions. When VIX is elevated and volatility strategies have more juice, I allocate more to it. If not, I allocate more to semi-directional or directional strategies, mainly when the market is trending. If the market is choppy but volatility is low at the same time, I will sit a bit more on the sidelines and have less allocation outright. So a little bit about myself. I'm an R&D engineer working in the semiconductor industry and living in Japan. I'm creating this channel to share with you my journey using a $50,000 account and trading options. Every week I will be doing breakdowns of my trades and sharing my strategies with you guys. So please subscribe to follow along this journey. Thank you.